This clip is not intended to be an exhaustive take on the IPO process. It's a teaser just to give you the gist of it. The first step in the IPO process is for the issuing company to choose an investment bank to advise the company on its IPO and to provide underwriting services. And the investment bank is usually selected based on certain criteria: their domain or expertise, their research analyst and capabilities, relationships with institutional investors, the strength of their sales and trading desk, and what type of post-IPO advice and assistance they can give in terms of mergers and acquisitions and follow-on financing. Obviously, its reputation is going to be a key consideration. Now, in choosing an investment bank, pre-existing relationships matter a lot. When the investment bank's been selected, a kick-off meeting is held, and this is followed by a series of key stages. Now, those stages can generally be broken up into the following categories. There's a drafting of a prospectus with the applicable regulatory authorities. So that could be the Johannesburg Stock and Securities Exchange, the Nairobi Stock Exchange, or the Securities and Exchange Commission. There's the releasing of the prospectus to the public. Then there's the formal marketing phase of the deal, what we call the roadshow. And finally, there's the pricing of the IPO. After the IPO has been approved by the regulatory authorities, the company and the investment bank must decide on two things. First, the price at which the shares will be sold, and secondly, the precise number of shares to be sold. Now, deciding this offer price is important because it's the price at which the issuing company raises capital for itself. Things that could affect the offering price include the success or the failure of the roadshows, and that will be recorded in the order books, and the condition of the capital markets and the broader economy at the time of issue. IPOs are often underpriced to ensure that the issue is fully subscribed or oversubscribed by public investors, even if it results in the issuing company not receiving the full value of its shares. If an IPO is underpriced, the investors of the IPO expect a rise in the price of the shares on the day of the offer. It increases the demand for the issue. Underpricing also compensates investors for the risk that they are taking by investing in the IPO. An offer that's oversubscribed by about 2 to 3 times is considered to be a good IPO. Now, the IPO is going to represent a new chapter for the founder and CEO. The company is going to get a new set of co-owners. There'll be pressure to deliver on the goals detailed in the roadshow. And with the highly visible and fluctuating stock price, there's the potential for the team to become distracted by this.